Good afternoon, ladies and gentlemen. Thank you very much for coming along this afternoon and giving us this opportunity to talk to you about this incredibly important strategic opportunity for our region. Todd and I are going to do a double act today, and we've got a presentation which we'll split between us, and we'll interchange between us in terms of the issues that the port's confronting and the issues that the regional council's confronting alongside the port as the 100% owner of Port of Napier. Just before I start, I think it is important to acknowledge, and actually the first thing I want to do is celebrate the fact that Port of Napier has just ticked over a record volume of 5 million tonnes of cargo this year. So that is the largest volume of throughput through our port in its history. The overwhelming majority of that is export trade, and I think that's a bellwether for the state of our region and something for which we can be enormously proud as a region. It signals the growth that's happening right across the primary sector, and it also really is testament to the wise decisions that were taken over 100 years ago in establishing this port and the way in which it has enabled the growth of our region and continues to do so. Today, the port is associated with nearly 27,000 jobs in our region, and a little over half of the regional GDP flows through the port. So there's absolutely no question that the Port of Napier is inextricably linked to our regional economy, and its growth is absolutely essential as an enabler for the future growth of what happens on the land in the wider region. So we're here today to talk to you about this growth phase that we're in, both as a region and for the port, and the choices that we face as a community and as a regional council and how that growth is funded. There's been a little bit of media in the last few weeks around this issue, and right now there is a detailed 16-page consultation document, copies of which are on the tables in front of you. They are going into every letterbox, including rural delivery across the region this week. So every household will be given a comprehensive picture of this current challenge that we'll be talking to you about today. We will talk through some of the issues and options in some depth that are in that document shortly. But in relatively simplistic terms, the port has a large capital requirement over the next decade, and the port management governance has informed the regional council that it needs in the order of $320 to $350 million worth of capital investment to cope with the forecast growth over the next decade. In the middle of that is one particularly chunky piece of infrastructure. That's number 6 wharf, which is currently going through a resource consent process at the moment, and Todd will talk a little bit more about that wharf. But that wharf alone requires a capital investment of in excess of $140 million. It will be a piece of infrastructure that serves this region for the best part of at least the next half century, probably longer. And as a consequence, it's a long-term investment, and it's a big step change in investment. And this port is now getting to a point where its size, its scale, its capital needs is becoming almost overweight in terms of the regional council's own balance sheet and mix of assets. So look, without getting into too much more detail, I invite Todd to come up now and run through a bit of a picture around this growth situation.
Look, before we go on, I think it's important we go behind the gates and just see what Napier Port does for the Hawke's Bay every day. I'm going to show you a little video that was recorded at quite a quiet time of year at the port, but it certainly gives you, I think, a little bit of an impression of how busy the place really is.
Napier Port has handled a record 5 million tonnes of cargo this year. 60% of that is bulk cargo, logs, fertiliser and oil products. A record 2.2 million tonnes of logs crossed our wharves, a staggering 37% increase on last year. The other 40% goes in containers, including a record 13.5 million cartons of crunchy Hawke's Bay apples and 480,000 tonnes of wood pulp to make paper products around the world. Our region is growing, and it's set to grow even more over the next 10 years. Napier Port is growing to keep our region connected to the world.
As you can see, it's pretty staggering growth over the last few years. Cargo volumes have been up around 25% just in the last couple of years, and growth is really set to continue. The wall of wood that we've heard about for many years has definitely arrived. Just to give you some sense of that, last year around 1.6 million tonne of wood coming through the port. This year we've just hit over 2.2 million tonne of logs, and next year we're looking in the region of 2.2 again, but even up to 2.4, 2.5. And that trajectory is continuing on for the next 5 years, even up to 10 years. We're looking at volumes in excess of 3 million. So it's pretty significant in terms of what's happening there. We're turning away bigger ships every year due to increasing congestion, and that the port's simply just not big enough to accommodate them all coming at the same time. Ships have been having to be moved in and out of the port. It's really a little bit like that movie, The Castle. I don't know if you've ever seen that, the Australian movie where you're having to move, the guys say having to move the Holden to get to the Tirana, to get to the back of the shed to get the Cortina, etc. It's a little bit like that in Napier Port at the moment. We're just having to move ships in and out just to bring other ones in. So that's having a real impact on our efficiency and productivity in the port as well, and just not sustainable. As I said, the growth forecast at the port is pretty compelling in terms of the need to do something and be able to accommodate that growth, and we're looking at volumes in excess of 57% growth in the period of up to 2028. So we've just hit, as James mentioned, 5 million tonnes. That will see us go well over 6 million tonnes and onwards up to 7-8 million tonnes in the next few years. So it's quite staggering what's going on. The bigger ships that we've all heard about, they're continuing to put a big strain on our infrastructure. Some of our wharfs are in excess of 100 years old. And just to give you a bit of a sense of the size and scale of the vessels that are coming through today, we sort of handle anywhere up to 295 metre long container vessels and about 33 metres wide in terms of beam. That's the biggest vessels that we can accommodate on our current container wharf. That we're at our limit today. And this year we're expecting to see more vessels in the vicinity of what we call 280 metres and 40 metre wide. Now you might think, well, that's a bit shorter, but actually the actual additional width on those vessels mean that the tonnage on those vessels goes significantly up. We're looking at going from a 60,000 tonne vessel to a 90,000 tonne vessel on 100-year-old wharfs. That were never designed to take that. So the actual age profile, the usability of those existing wharfs diminishes rapidly when you're getting those sorts of tonnages leaning up against our old wharfs. So we're going to have to do something anyway in terms of being able to accommodate that. Those bigger vessels are arriving in New Zealand regardless of whether we like it or not. They are coming, they are here. To compound this, we're also seeing that cruise is a hugely popular choice for tourists coming to the Hawke's Bay. Last year around 57 cruise ships, this year we'll do 71. Those are all coming within a short period of time and quite a condensed time frame, which makes the whole port congestion issue that much more difficult for us to manage. We've got bookings the year after for 88, and then beyond that, I could say yes to many more, but physically we can't handle any more at the moment. So whilst it's a hugely popular and fantastic thing for the Hawke's Bay region, we're making choices this year to turn away around 7 ships. That's a $3.5 million contribution that we believe that's a lost opportunity to the Hawke's Bay if we can't do that. So yes, Napier Port's cargo volumes have grown steadily, and the port it will continue to need to support and maintain the ability to assist our exporters and local growers in their businesses. Between 2016 and 2018, we're predicting continued steady growth on our cargo volumes, and as I said, we've already just reached a massive milestone with 5 million tonnes, and you'll no doubt see. Girls did want me to wear this today, but I thought I wouldn't quite go there. But we will see these popular T-shirts around the A&P show over the next few days, celebrating the fact that we've hit a major milestone. So meeting this demand is going to be very challenging for the port. Typically, the port, in terms of its occupancy and capacity, would look at wharfs being occupied around 50% of their time. You might think that's not too much, but that's a bit of an international standard around about when you have to do something significant around investing and increasing your capacity in a port. Napier Port at the moment is hitting around 70% berth occupancy. So on an international standard, we're well beyond where's acceptable limits. Until we can build a new wharf, and in this graph here, what that's sort of showing is those 4 years is really what we're focusing on right here and now. That's about building resilience into the port to get us through to the point where we actually have a new wharf available in 2022. So to do that, what we're having to do is invest around about $40 million in just the existing infrastructure and in additional tugboats, new crane technology, new reefer towers, and more work on our existing wharfs just to get us through. So that's all about building resilience just for here and now. And you will see and probably hear in various different media and publications the fact that we are levying different users of the port for that infrastructure immediately. But that's a long-term game that we have to play there with those users. We can only make our footprint work so hard. And it's not uncommon for ports like ours and any other port in the world to have to go through quite a step change in terms of infrastructure. And these big pieces of infrastructure, as most of you in the room will appreciate, come at a big price, and they are certainly step changes in terms of the level of investment that a port or any other major infrastructure business has to make. On average, we're spending anywhere in the region of sort of 15 to 20 million a year in capital works programs at the port. This is obviously a massive step change in that regard. But as James mentioned, this will be something that will take us through for the next 30 to 50 years, and it's something that's whilst it's a substantial investment in the port, big decisions like this have been made in Hawke's Bay before and not been regretted. And the port has benefited the Hawke's Bay over many generations, and we believe that this investment today will also benefit the future generations of sheep and beef farmers, foresters, apple growers, and your children and your grandchildren. So I think it's a responsible thing to do.
So of course, none of this has been considered in isolation of the Regional Council's wider set of responsibilities and our overall group balance sheet. As many of you will be aware, the Regional Council was formed about just under 30 years ago through the combination of a number of previous entities, but most particularly the Hawke's Bay Catchment Board and also the Harbour Board, and that brought the port together alongside our catchment responsibilities. That's enabled us to generate a revenue stream to subsidise council services, and in the current financial year that's to the tune of $10 million by way of dividend from Port of Napier, and that's subsidising rates to the tune of $140 per ratepayer per annum. So it's made a useful financial contribution to enabling the council to do its work historically. However, as the port requires more capital, we're faced with a question of raising additional debt and the potential increase in cost on ratepayers and servicing that debt in the option set we confront. And I think it's important to recognise that the Regional Council is facing some fairly significant challenges today and will do for decades to come. The image up there takes us back to the weather event we had in 2011. Some of you will remember the weather bomb that came through. That's a photograph near Lake Whakaki, near Wairoa. That is one of our most important freshwater wetlands, and it is heavily degraded from sediment volumes from the surrounding landscape. And what we do know from our science is that sediment from our hill country erosion is the single biggest stress on our freshwater ecosystems and also on our marine environment. And Hawke's Bay's got a lot of erosion prone country. We've got nearly 280,000 hectares of our land, about 10% of the region is highly erosion prone. And that presents us with some significant challenges with respect to climate change, because the sorts of events that we experienced in 2011 and in the last year we've had some smaller events in the Mangoni and Esk valleys from tropical systems coming down as increasing surface sea temperatures increase north of New Zealand. We are expected to see more frequent and intense heavy rainfall events, and so all that will do is accelerate and exacerbate these challenges we face around the impact of erosion on our freshwater environments. And the reason that I draw this to your attention is that the Council has raised rates in the last year, and people will be acutely aware of that, and we have an increase in rates program for the next couple of years as well. And we have a heavy borrowing program. So in our long-term plan, which started this year, we forecast an additional $70 million worth of borrowing over the next 10 years. So borrowing additional capital to fund the port's growth sits on top of that debt. And so it has to be seen in the context of the full range of responsibilities the Council has and its ability to fund those, and the ratepayers' ability to fund everything that needs to be done. I'd also note that freshwater reform is something which commenced the last time Labor was in government. It continued through with increasing intensity under the last National government. The new Labor government's promising greater levels of regulation and more effort in this area. So the Hawke's Bay Regional Council, like every regional council in New Zealand, is now legally required, and indeed our communities are expecting us to do markedly more to improve the quality of our environment, particularly around the intersection between land use and fresh water. So it's certainly my view, and the view of the Council, is that this is not a passing political fad. This is something which is broadly supported across the community and broadly supported across the political spectrum. So we're going to be in the business of improving land and water quality for decades to come in this region. And there's no question, based on our understanding of the scale and the urgency, that this is going to be incredibly resource hungry. So that leaves us somewhat stuck between two hard places. On the one hand, we've got a fantastic opportunity with a prosperous growing region and a port which has been very successful and served the ratepayers, the exporters and the Council very well, and an opportunity to support its future growth and for the Council to benefit from that. But on the other hand, we also have this increasing burden on our ratepayers and this increasing need for the Council to use its balance sheet to drive the interventions that deliver those environmental outcomes we're required to do. And so that has really happened almost simultaneously with this need to build Number 6 Wharf.
So, 6 Wharf is absolutely critical to the port's future, and based on today's estimates, it'll cost around us about $142 million. So as most people will appreciate as well with these big infrastructure investments, numbers do tend to move around a little bit, but that's our current and most up-to-date estimate of the cost of just 6 Wharf alone. Construction needs to start next year in order for it to be ready by 2022. It's about a 2-year construction process by the time that we work through the actual physical construction of the wharf and the dredging process, etc., that's needed to accommodate the vessels coming in to arrive on that side of the port. The wharf will allow us to handle bigger ships. It'll be 350 metres long. It will have the capability to handle most of the types of vessels that are arriving into New Zealand today and into the future. It will help us to handle more cruise ships. It will free up some of the other wharfs that we have today that are having to be evacuated when we bring in other vessels, and improve the overall efficiency and productivity, and potentially also the safety of the port as well. Our resource consent process is underway. We are expecting an outcome from that towards the end of this month, if not by the latest around about November the 5th. And we're very hopeful of a successful outcome from that process. A lot of hard work's been put into that and a lot of consultation with the community. So, we see this as an absolutely critical piece of infrastructure for the future of Hawke's Bay.
So while the strategic importance of the port is pretty obvious to probably everybody in the room and hopefully the wider region, we have another set of strategic assets that sit a little bit more quietly in the background, and they are our flood and drainage network across particularly the Heretaunga Plains, but not only, in some other parts of the region such as the Upper Tukituki. The economic analysis that's been done on those assets suggests that for every dollar we have invested in those flood protection networks, we get somewhere between $60 and $100 benefit as a community for each dollar invested. They enable the populations to exist here on the Heretaunga Plains, and they enable the horticulture and viticulture primary production that occurs here and in the Upper Tukituki as well. Those assets have served us extremely well historically, but they're built to a 1 in 100 year exceedance probability design standard. And if people hadn't noticed, 1 in 100 year events seem to be happening around the country with a little bit more frequency than once every 100 years. And again, the expectation we have from climate change predictions is that we will need to invest more heavily in the flood and drainage network across the region to lift those protection standards because of the enormous economic loss that this community will suffer in the event of a major failure of our flood protection networks, particularly here on the Hiratonga Plains. So while we are doing some design work on increasing the level of protection to 1 in 500 years, we have not yet budgeted the full cost of doing that. So when we think about the Council's balance sheet over the next couple of decades, enabling the borrowing and the building and upgrading of those flood protection networks and coastal defences where we're facing coastal erosion and sea level rise issues is a very significant challenge. And so that leads me to diversification of the Council's assets. At the moment we do have a very high level of concentration of the Council's assets in the Port of Napier. And while that has delivered us a solid dividend and it represents nearly 20% of the Council's revenue, it does mean that in the event of a major event, and we certainly saw that occur at Centreport following the Kaikoura earthquakes and at Port of Littleton following the Canterbury earthquakes, that the Council will need to stand in behind the port in relation to its undoubted impact in terms of its performance and level of service following a major event. And we're very conscious of the fact that this will not be the only asset that would be impaired during a major earthquake or a major tsunami or the like. It's likely that the Council's other assets will also be endangered. So when we look at our overall risk and the management of the Council's financial resources and what would be prudent, it is striking how many eggs we already have in the basket of the Port of Napier. And if we are to continue to fund wholly through ratepayer borrowing and rates themselves, what we will do is continue to concentrate that risk over time. So I think Todd's laid out a fairly clear case for why Sixth Wharf needs to be built for the regional benefit. And it's clear from the Council's perspective that doing nothing is not an option. So we need the wharf to proceed, and we need it to proceed at pace because the lead time to design and build it will probably be in the order of 3 years. So the issues the port's facing today with congestion, turning away cruise vessels and the like, will only be worse in 3 years' time than they are today. So every day that we delay is another day of potential economic loss to the region. So we need to move forward on this issue, and therefore the Council has had to consider the full suite of options in terms of how to resolve the funding requirements of the port. We set up a capital review committee over 18 months ago now, and they explored 9 options, and those have been whittled down by the Council to 4, which are included in the consultation document which is before you and being circulated this week. Those options are principally, there are 3 which the Council has put on the table as not preferred. Now I should say at the outset that the Council's initial preference was not to state a preference, but to put all the options on the table for the community to consider, and then to arrive at a preference. Unfortunately, under the Local Government Act, the Council is required to state a preferred option when it goes out for a special consultation that it is required to do of a decision of this nature. So there are 3 options there which are not preferred, the first of which is the status quo, effectively. The Council borrows, and in this case we've modelled it on borrowing the full current debt level of the port, $86 million that the Council borrows off its own balance sheet, pays off the debt of the port. The port is then in a position is recapitalised and is in a position to borrow to fund Sixth Wharf and those future capital requirements over the next decade. That would equate to just under $1,000 per household over the next decade. And next year, if we were to pay that $86 million off over a 10-year period, that would result in a rates increase next year of around $140 on average per household. Obviously, rural landowners would be significantly more, and that equates to that plus the programmed in rate increase would be a 52% increase in rates next year. We've also looked at the idea of having a strategic partner to come in and take a minority stake in the business. And what we have seen as we've looked at other models like this and taken advice on it is that we would likely get a lower price for that relationship than we might get from a public listing. It would be discounted in terms of that minority partner not having control of the business, but on the other hand we'd expect them to negotiate a shareholder agreement that gave them significant rights of veto over major strategic decisions. So effectively we would be in partnership with another partner. It wouldn't enable local businesses, local residents to necessarily buy into the port either. It would probably be with an entity, given the scale of capital that's required, from outside of the region. The third option that was considered, and this is the common model in Australia, was to lease the port for a period of time, likely to be in excess of 50 years, to an investment partner or consortium that would take over the running of the port. They would pay up front the council the net present value of the future cash flows that the council could expect, and then they would be able to run the business as they saw fit. That would require a reasonably complex contractual arrangement that the council would need to negotiate, and it would need to look far into the future and anticipate all the issues that would need to be covered off over, say, a 50 or 100 year period that would need to be built into a contract. So as we've looked around Australia, and some of us visited 4 ports in Australia last year to look at it, it is quite a complex model, and there is a significant loss of control. So the council's weighed this, and it has determined that its preferred option is a share market listing of a minority stake of the Port of Napier. In the consultation document, all the financial modelling is based on a sell down of 45% of the shares in the company, although we are consulting on the ability to sell up to 49%, and that's to ensure that we do have the flexibility, if required, to go to that level but still maintain control. But certainly the council's preference is to go no further than 45%, and that is indeed what the financial modelling is based on. The benefit of a share market listing will certainly be, in the first instance, the ability obviously to raise capital. The council is proposing that it would in the first instance pay off all of the debt from the proceeds of that sale, so that the port company starts recapitalised at zero debt and can then undertake that borrowing program that we've referred to previously. That would then list the company on the New Zealand Stock Exchange in the best possible shape, with a consent to build number 6 wharf, and with that underway. It would enable local residents to buy into the business, and we are proposing a preference pool for local residents and ratepayers and port staff to enable them to buy shares. And certainly we'd be keen to see as much Hawke's Bay ownership outside of the council's ownership in there as well, but we also need to ensure that there is good liquidity in that. We'd expect a fair bit of interest, and we've certainly heard a fair bit already from KiwiSaver funds and institutional investment funds, if you like. People will be aware that there's been a dearth of listings on the New Zealand Stock Exchange in recent times, and certainly assets of this quality that are GDP indexed in terms of their growth and turnover are few and far between. So we would expect there would be considerable interest, and the share price would reflect that. So this option very much, in our view, protects ratepayers because it also ensures that we don't need to raise rates. And the reason for that is that in selling off 45%, the council's still left with 55% of the dividend stream, and in paying off that initial debt in the business, there will be reduced finance costs in the business, at least in the short term, until the borrowing ramps up for the capital works program. So there's a short-term uplift modelled in the dividend flow, and then the growth that the business is seeing is going to continue to deliver increased performance in terms of dividends. The funds released, and at the end of paying off that debt, we're modelling $83 million being available to the council for reinvestment. We would put that alongside a current portfolio that we hold of around $50 million in managed funds in a diversified way, and we're modelling a 5% return on that, which is probably reasonably conservative. That plus the retained dividend stream results in an upside to the council of nearly $2 million in the first year. So it enables us either to do more or to reduce pressure on rate increases. So combined for that, it does put us in a situation where we are protecting the ratepayers' interest in terms of diversification. We're funding the growth of the port. We are ensuring that the impact on ratepayers, particularly in that wider context of increasing pressure on ratepayers, is duly managed. And most importantly, we are retaining control and influence over the port in the longer term. So that's what's proposed. Todd and I are very happy to take some questions. I think in closing, we would just encourage you all who have views on this matter to get involved, get informed. There is a large amount of supporting documentation on our website that goes into the deeper financial analysis for those that are interested. We have a whole range of events happening across the region in the next month, and we will be holding public hearings, and we welcome submissions and submitters coming and being heard and sharing their views. The council has not made a final decision, and indeed it is required by law to maintain an open mind, to hear all the views from the community, and to take sound advice before making a decision. We are, at this point in time, anticipating that a final decision may be made before Christmas, possibly at a council meeting on the 19th of December, but that will depend on whether the council at that point feels like it has sufficient information and doesn't wish to seek further advice and analysis before arriving at a conclusion. So we're now very happy to take any questions and have any discussion.
Yes, James, why don't you just borrow the money? Why hasn't the port just borrowed the money full stop?
Look, I might ask.
Can you repeat the question, James?
The question is, why doesn't the port borrow the money that's required? I'll give an answer, and Todd can perhaps add to it. So the port currently has $86 million worth of debt. The volume of debt that's required to fund Six Wharf and the other capital improvements that are expected over the next decade have been modelled, and they show that the debt to earnings ratio gets to a point of the business effectively being sub-investment grade. So it does get to a point where it affects the credit rating, if you like, of the port, and it places it at a degree of vulnerability. Now, when we look at what's happened with Centreport and Port of Lyttelton, and we reflect on what happened at Port of Napier in 1931, and we do recognise that the unforeseen does happen from time to time. We could get a major weather event that has a big impact on primary production here. We could get a major biosecurity event. There are a whole range of things that could happen that place pressure on the business. And so the question that the board of the port is confronted with, and the councillors as well, is whether it is prudent to push that debt level to that level of discomfort. Todd, anything you want to add?
No, I think that pretty much covers it, James. It's more about prudent levels of debt.
James, if you go in the direction of a public float, how big a sort of public company do you think you'll end up with? I mean, is it going to be in the sort of top 50? Can you compare it with for instance? Have you done that sort of work?
So our advice from the New Zealand Stock Exchange is that listing on the top 50s, it's an algorithm based on not only market capitalisation but liquidity. And one of the things that we'll need to look at very closely in terms of doing the book build for the allocation of shares is to ensure that there is liquidity so that we certainly discover a fair share price. And so there is some uncertainty as to how quickly it would make the top 50. The candid advice I had from the Chief Executive of the New Zealand Stock Exchange is in his view, it would make the NZX 50 in relatively short order. That was his view based on his view of the growth of this asset and the level of interest that is expected from the marketplace. The other thing that he said to me, which I hadn't considered, was that he thought that this listing would put Hawke's Bay more firmly on the map. He said that there was a halo effect around Port of Tauranga's listing. It signalled there was economic strength in the Bay of Plenty to the wider investment community and the wider business community. It generates more business news on an ongoing basis around the performance of the port, the throughput of the port, and the wider regional economic performance. So it's a way of transmitting to the broader investor market that Hawke's Bay is open for business. So I think there is potentially some real benefit there for a listing.
I'll just add to that last comment as well, and just echo what James said. You know, the amount of the people I talk to in industry around the port, some of our customers and potential customers, particularly out of region customers, are very much interested in what's going on and what our future plans are. Some of our customers at the moment know that we're reaching kind of capacity level and are looking at what's the future direction of the port and how we're going to be able to sustain and support their businesses going forward. So, to James's point, I think a listing of this sort actually gives us options and flexibility as a port, but equally it does really make a mark for the Hawke's Bay and say we are open for business and we're here for the long game. Not only for the shipping lines, but I'm talking more about New Zealand cargo owners and what they're looking for and what they need for their distribution models in the future. Yeah.
My name's William Peacock. I'm from Waterways. My history is my grandfather spent 25 years on the Napier Harbour board since infancy. I come from the point of view of don't sell the port. I believe that we should be charging all the ratepayers to pay the extra rates. I'm quite happy to pay $1,000 a year to keep the port going. I'm now a superannuitant. I do have interest in forestry, so I need the port. So I'm quite happy to pay $1,000 a year. And have you considered raising the benches where you retain full ownership, but if they're interest-bearing, the benches are taken up by the people at Hawke's Bay? Consider that.
Yeah, so the short answer is yes, we have, and I guess one of the issues around that is it's effectively another debt instruments. There's a whole different range of ways in which we can raise capital that are various forms of debt. They don't get round the issue of further concentration of risk, if you like, and the council having more eggs in this basket. But look, I should say at the outset, and our chairman said this on a number of occasions, that this is not a situation that we wanted to be in. In an ideal world, we would do everything we need to do, keep rates down, continue to own this wonderful asset. We love owning the Port of Napier, and we'd love to, ideally keep it that way. But we do face some big trade-offs, and I really do have the sense of the port now growing to a point where it's almost becoming too big for the regional council to own on its own, if you like. So that is an option. In terms of the impact on ratepayers, we believe there are many people in the region that would happily stump up another $1,000 over 10 years, or even in some cases $1,000 a year for this purpose. Earlier this year, when we consulted on our long-term plan and our rates increase, one of the things that struck us is the number of people that found a relatively modest rate increase to be a terrible burden. They came out in their droves, particularly in a meeting we had in Wairoa, and certainly in Waipawa as well. We had large halls filled with people who were very concerned about those rates increases. And so there are an awful lot of people in our community on fixed incomes, particularly superannuitants, and a growing number of them, who will feel the impact of another $140 a year or thereabouts. But look, it remains an option on the table, and if the community overwhelmingly wants to retain this asset 100% and pay for it through rates, well, then that will have to be probably where the council lands, if indeed that's the overwhelming view.
Excuse me, James. Thank you for your presentation, gentlemen. Can we just come back to this gentleman's question? When you're talking about the liquidity and prudence and all that sort of thing, you're talking about a very short period in that 10-year spend, aren't you, where the pressure would be on? It would only be a very short time, isn't it, in that 10-year period of borrowing?
Yes, it does peak, and it does start to be paid down over time. I haven't got the information in front of me, but it is on our website in terms of the supporting documentation that shows that debt profile and how it levels off. I guess this is a question of judgment for the directors of the Port of Napier and for the councillors themselves. Is it prudent to have 1 month, 1 year, 2 years, 3 years of being at that very high level of indebtedness? And what is the counterfactual of something happening during that period? And what are the unknowns or uncertainties in the financial modelling that might not be as we expect them to be?
Yeah. When you talk about unforeseen things, so Hawke's Bay has publicly floated a local company before, and there were some unforeseen issues that happened there. That was with Richmond, so that sort of didn't go quite so well.
Yeah, so in terms of the council retaining control, we've looked closely at the experience of Port of Tauranga, and I think what's really important there is to maintain liquidity in the investor base and diversity in the investor base. What we'd want to ensure is that there is no appreciable risk of concentration of shareholding by a particular party that could mount a takeover bid. Based on what we've seen with Port of Tauranga and the advice we've received to date, is that is manageable, but I recognise that is something we do need to avoid.
Yeah, it is something though in your presentation today that you haven't really talked about, because the other part of what you're selling is you're saying up to 49%. You don't need to even sell 45% to cover the $86 million debt right now. So just as a ratepayer and the actual owner of the port, the people own the port. The council doesn't own the port. You hold the port. It is ours. Selling more than what you need to gain almost double the income required to clear that debt, I think is a very bad thing.
So I just would stress the fact that one of the objectives that the council set for this exercise is diversification of risk across its portfolio. And so you're absolutely right that we could sell a smaller proportion of the shareholding and still achieve the funding of Six Wharf. But look, if we're going to go down this path, the view of the council is that we should achieve those broader objectives around risk management as well. So going up to 49% is being consulted on to provide that leeway. We haven't yet done the listing strategy work yet, because that we can't do until we've got a clear decision from the community that they are prepared to see an IPO option pursued. And it may well be that that listing strategy suggests that in the short term we do sell a smaller proportion and hold back some shareholding, and then make some further decisions further down the track. So that's certainly not off the table. Thank you, everyone. Really appreciate your attention, your attendance, and the great questions. Thanks, Simon. Thanks, James.
Thank you much, ladies and gentlemen. Thank you to both Todd and James for a very thorough and quite a complete presentation, and we certainly appreciate the opportunity to hear from both the port and the council. So on behalf of the AMP Society, I'd just like to present you with some light reading. I'm sure you all like to have some light reading. Indeed. So well done.
Thanks so much. Cheers.
Once again, ladies and gentlemen, I'd just like to thank the Regional Council for hosting this luncheon today. Great opportunity, and of course it's great for the AMP Society to showcase our event, what we do, and we're an AMP show, and certainly behind you, as you see, that's in full swing. Certainly invite you to certainly come and have a look at the show today, and we're open till Friday, and the weather's going to be the same right the way through. We've got that ordered, so we certainly enjoy sort of seeing you there and taking advantage of the show here. There is tea and coffee available. By all means, the table's outside if you'd like to have a seat outside and enjoy the sun and the show jumping. But on behalf of us all, thank you all very much, and we'll see you all again. Thank you.